Close Brothers Group shares jumped almost 17% on Thursday after the bank disclosed that its total exposure to the FCA's motor finance redress scheme now stands at approximately £320 million. That is higher than the £294 million already held as a provision since January, and the market celebrated anyway. The apparent contradiction dissolves the moment you understand what the number replaced: 2 years of open-ended guessing. Motor finance has been the defining overhang on Close Brothers since the FCA began examining discretionary commission arrangements in 2021. The practice, now banned, allowed car dealers to set interest rates on loans and earn higher commissions the more they charged, a structure that cost millions of UK drivers more than they should have paid. The FCA describes the scandal as the worst consumer finance episode since PPI, and its redress scheme covers approximately 12.1 million car loans written between April 2007 and November 2024. For Close Brothers specifically, the scheme touches around 720,000 loans. The central bottleneck that drove Thursday's rally is not the £320 million figure itself, it is the fact that a quantifiable figure now exists at all. Prior to the FCA's finalized framework last week, brokers admitted they were working with estimates that amounted to, in Pamir Liberum's words, largely a guessing game. The guess is now a number, and in the arithmetic of how markets price uncertainty versus known cost, a higher number with a floor can trade better than a lower number with no floor. The provisional answer to why a rally follows a larger liability is this: the market had already assumed a figure at or above £320 million and had sold the stock accordingly. Close Brothers had fallen 7.9% in the month before Thursday's disclosure, lagging the FTSE All-Share by 9 percentage points. The new provision simply confirmed a range the market had implicitly priced. It did not extend it. What it added was confidence that an emergency equity raise, the scenario that genuinely threatened holders, is now off the table. Pamir Liberum stated that directly. The market should have confidence the company will have to avoid an equity raise.
The relief rally is real, but the floor it is built on deserves more scrutiny than Thursday's move suggests, because the £320 million figure is not an agreed settlement. It is management's estimate, derived from assumptions a court has not endorsed. The most material of those assumptions is the average payout per customer. Close Brothers has modeled £500 per claimant. The FCA's own industry-wide estimate is £829. Management's explanation is reasonable on its face. Close Brothers says its loan book skews towards smaller loans and lower commission rates than the industry average, but the FCA and courts will ultimately determine whether that differential holds. A shift from £500 toward £829 across 720,000 affected loans does not fit within the existing £374 million of capital headroom Shore Capital calculates sits above the minimum regulatory requirement. The gap between the two average payout assumptions is not academic. The take-up rate assumption compounds the uncertainty. Management has assumed 75% of eligible customers will claim. A 5 percentage point movement in that rate shifts the total bill by roughly £18 million. At 80% take-up, not an aggressive scenario given that the FCA actively directs claimants toward the free scheme rather than law firms, the £320 million estimate grows meaningfully. Shore Capital's Gary Greenwood noted that motor finance uncertainty remains the central overhang on sentiment, and that the recent legal developments, a court-mandated partial suspension of the FCA scheme, with hearings scheduled for December 2026 and February 2027, offer no meaningful new information on the eventual scale of industry compensation costs. That last phrase is the point most analysts are skating past. The scheme suspension is what triggered the disclosure and the share price move, but suspension is not dismissal. The FCA has made clear that if the court overturns the scheme, it may instead direct lenders to resolve complaints individually through the standard complaints process. An approach Nikhil Rathi told MPs could cost the industry an additional £6 billion and take until 2028 or beyond to resolve. The investor read of Thursday's news as resolution is premature. What it actually represents is a pause in the legal process that forced Close Brothers' hand on disclosure. The provision is not final. It is the management's opening number before the court has ruled.
Set the residual uncertainty against what is now known about Close Brothers' capital position, and the picture becomes more navigable. If the full £320 million provision is recognized, the group's CET1 ratio falls approximately 25 basis points to 14%. That sits above the medium-term target range of 12 to 13%, meaning the bank absorbs the stated liability without breaching its own floor, let alone regulatory minimums. Shore Capital puts the excess capital headroom above minimum requirements at around £374 million. That is the structural reassurance underneath Thursday's move. The December 2026 court hearing is the verification anchor. It is where judges will hear challenges from Volkswagen Financial Services, Mercedes-Benz Financial Services, Credit Agricole Wado Finance, and the Consumer Voice Consumer Group. A ruling is expected in the months after, meaning a final judgment could arrive in mid-2027. The outcome splits into two variations. If the FCA scheme is upheld, Close Brothers' £320 million provision, built on the scheme's framework, becomes the working liability ceiling, and the company's management target of double-digit return on tangible equity by 2028 becomes the relevant forward metric. Short Capital calculates that a sustainable 10% return on tangible equity justifies a share price of around 655p, significant upside from the post-rally 408p level. If the scheme is overturned, a complaint-led approach brings higher costs, longer timelines, and a reopened liability question. The rally reverses its basis, and the capital headroom calculation must be rerun against a larger, slower resolving number. For holders, the trigger to watch is not the next quarterly update, but the December 2026 hearing outcome. The existing £320 million provision is not provisionally safe until the court confirms the FCA scheme framework it is built on. For those on the watch list, the entry setup is a scheme-upheld ruling that locks the floor at or near £320 million and clears the path toward the 2028 ROTE target. That is when the 0.5 times tangible book valuation becomes the entry point for a re-rating towards 655p. The trap is a scheme-overturned ruling. The liability reopens, the provision understates the exposure, and the capital headroom Shore Capital cites shrinks against a larger court-driven claims process. The December hearing is the single checkable event that resolves which outcome the Thursday rally was pricing. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.